All right, thanks for showing up to 0 Days to Expiration. This is podcast number 102. And today we're going to talk about how the market actually has a memory, or what I like to call a footprint, and it's a long-term memory. It goes way back. So what's that all about? What do you mean a memory? Well, I'm going to show how that long-term memory, that footprint, that price action from a long time ago actually provides actionable trading levels right now, in the present, at the present moment, or whenever you're trading. And that's all done through volume profile. Now, here's the deal. Volume profile, in my view, is pretty much totally misunderstood. And that's mostly because most people are following a standardized method that was originally born out of market profile, which is a little bit different than volume profile in that it would come up with something that looked very similar. And I'm talking about those bell-shaped curve nodes and things that stick on the side of your chart, and they come out the side there, and they're supposed to show the height of volume and so forth. Market profile originally was based only on price action and ticks, and it had something called time price opportunities, or TPOs, which would break the market down into 15-minute segments and then provide, well, where that 15-minute segment was spending most of its time, and then it would advance and it would label it with letters and all kinds of other stuff. It was kind of cool. But from there, they came up with all the tenets and basics of what volume profile would be. Eventually, instead of tick data, that was replaced with volume, which was proved to be far more accurate. And that's the way most people look at that market profile now, is volume profile, because of its accuracy. I think tick data would only show about 93% of what the actual detail that you needed in order to see what price was doing and what that effect was. So anyways, through market profile, they came up with a whole bunch of different terminology that was passed on to volume profile. Things like the point of control, or POC, or the LVN and HVN, or the low value node and the high value node, which were these arbitrary points that they would put on the profile that would give it a different color to show where one standard deviation of all of the price action happened, or all of the volume action, more accurately. And so they would use these things, and then they would continue with the market profile paradigm and show a lot of these profiles on sessions only. So you would see the profile of volume for that trading session. From, in the case of SPY, for instance, it would show you only the profile from the time it opened in the early morning at 9:30 until it closed at 4 o'clock. And that's interesting. That is, if you only care about those times. We know that the SPY, which is really an ETF that is describing the S&P 500, and the only real thing that captures the full expression of the S&P 500 has to be considered futures, because futures are around the clock. You can trade the S&P 500 through futures 23 hours a day and 5.5 days a week. That's literally 4 times more than you can trade on the SPY or even the SPX. Now, the SPX is a special case. It is a calculated index that is calculated based on the pricing of all of the 500 members of the S&P 500. And then it gives you this index that has no volume. It's only price, and it's only displayed in normal market hours. Now, recently, they've extended that to outside of market hours because they recognize that a lot of stocks and other things can be priced that way, and so you have that. But most brokers don't even allow that. Now this is really what I'm talking about right now, and all of this stuff is details that you don't really need to know, and they have nothing to do with what I'm talking about, and that's that memory. But it's the same thing when you start talking about HVNs and LVNs and point of control and TPOs and all of that stuff, or session profiles, because they're not showing the true power of volume profile. and that is that it is the perfect indicator for showing you things that happened in the past. And when I say in the past, I'm not talking about yesterday or last month. I'm talking about last year or 2 years or 10 years ago. This market memory is really quite impactful, and it can give you clues on where price is going to find support and resistance and liquidity or low liquidity areas of the range of prices in real time. And you may wonder, how can that possibly be? I mean, that happened a long time ago. I've been doing a lot of study on market behavior and different ways that you can model the markets, and also looking with my own personal experience using volume profile, and then discovering things that are outside of what most other people are looking at. And what I found was, well, some work that was done by some notable mathematicians, namely Benoit Mandelbrot, who saw financial markets as an example of wild randomness characterized by concentrations and long-range dependence. He developed several original approaches for modeling financial fluctuations using fractals. You see, economists are these people that like to put everything in a nice, tidy little box. And while they may be perceived as scientists, what they're really trying to do is take their ideas of what the market should be, and that is this sort of smooth, straight-lined, or perfectly curved mathematical models, and everything else must fit into that. If it doesn't fit into that, then they'll call them aberrations. So the standard distribution model, or the bell curve, is a good example of this when they're showing the distribution of returns over time. And of course, when we look at the actual distribution of pricing and volume over time, it doesn't fit that standard bell curve very nicely. Sure, it's an approximation, but that's all it is. It would be like saying I could look at mountains and describe them with, I don't know, with footballs or with a basketball or different spheres, and just put them in their place. And anything else that came outside of that, the realm of that sphere, must have been this aberration or something anomalous, which is patently ridiculous. And that's where Mandelbrot comes in with fractal geometry and showing that everything can be described in these sort of irregular patterns that can be repeated, and that you can see these patterns in very small spaces, and then they can be expanded, and you'll see similar patterns at different levels or different viewpoints. So, for example, you could see some patterns that might happen when you're looking at a day's worth of data. And then when you zoom out and you're looking at a month worth of data, you can no longer see that individual day, but you can see the same kind of pattern happen at the month level. And then similarly, if you move out to the quarter or even to the year, again, you can't see the individual patterns. They're just, they're too small to recognize, but you see the same kind of pattern happening at those levels as well. So this is sort of the basis behind fractal geometry in order to be able to describe something that the economists can't describe with their smoothness. You really need something that matches the actual roughness of the market or real systems. Mountains are rough. They're not these smooth things. And markets are rough too. They're not smooth or cannot be described by smooth things. The other thing is that economists' financial models assume incorrectly that one day's price is completely independent from the last day or 2 days or 3 days previous or 5 days. The conventional wisdom is that price takes this kind of random walk and everything is completely uncorrelated. Despite this, economists recognize that there are some correlations, and so they look at these as kind of anomalies, and they'll go back and they'll measure these correlations, and they'll come up with different ways to describe them, but still their skepticism and their ignorance prevents them from actually seeing what that correlation really means. Now, the fact is that these anomalies or this roughness or these patterns, they actually exist, and they don't just exist in just a few random cases. They follow more along the Mandelbrot ideas, patterns that repeat over time. Not only do they repeat, but they have a kind of memory to them. So events that happened months or years ago, that memory still has some sort of imprint in the cosmos or in the structure, in the, um, well, I guess you could call that the market structure that lasts for days, months, years, even decades. So, I mean, that that is something, and it's not just the markets. Now, this happens everywhere in nature, with human events or natural systems or even human systems. Things that occur, like the water floods in a basin or market fluctuations, they all have this lasting memory that actually exists. It's one thing to take the word of one of the leading mathematical scientists ever. It's quite another to see this market memory for yourself. And you can actually, and what I'm to say is that, sure, I am really a fan of Benoit Mandelbrot and his work on geometric analysis. I mean, it's absolutely brilliant, and it really describes natural systems for sure. Now, being able to see though this market memory in reality is quite another thing. That's a different application that I haven't seen him look at. But I've been practicing this for a long, long time with market profile and showing that you can actually chart out the market structure of a market by looking at its profile of volume. Now, volume profile is essentially a horizontal type of view at the market that looks at every single price level and the amount of volume that happened across that market at that price level, irrespective of time. So you could pick either a short period of time or a very wide period of time. Now, I choose in most markets to look at up to a year to 2 years worth of time and then see the individual volume levels throughout that entire span of time. And what I've noticed is that there are definitive areas that show these value nodes that pop up, as well as the absence of a value node, which a lot of people call low value nodes. I call them volume wells because they are the absence of value nodes or volume nodes. And so there are these two very distinct kind of features that will show you where the market had a lot of value or volume and where it didn't have value or volume. And so you can almost make judgments on what the market is thinking as a whole. Now, the market is made up of millions of participants and over many, many years. So it would be weird to say that it has some kind of memory or psychology or intelligence, but that's really the only way that you can look at it. It is a very complex, chaotic, with patterns type system. So it does have something to it. And even if the market itself doesn't have that intelligence is built in terms of some kind of mass intelligence, I think is the best way to look at it. This group intelligence that grows. And from that, you can actually discover places where this group intelligence decides where there is value in the market and where there isn't value in the market. Now, in terms of this work that Mandelbrot did, I mean, he's looked at and he's actually studied different systems and things like this long-term memory concept that appears in just about every kind of natural system and every kind of human-made system. And so that's really important that I want to bring that into light. Now, but the fact is that these correlations and their memory are long-lasting, as with, like he had mentioned, the rings of a tree trunk. Maybe during a particularly cold season, you have a very small ring, right? And then if you were to look at other cold seasons, they tend to follow a pattern. You would see that the next year tended to also have a small ring. You didn't have this random division of rings on a tree trunk. They would tend to slowly, gradually move in and out. Sometimes there would be a cataclysmic event or something that was outside of the norm. But it tended to happen in groups or patterns in the same way that you see this happen in the markets, where you have this group or patterns of nodes or whatever. You have areas where the markets tend to consolidate and areas where the market tends to trend. I mean, that's basically how the market works. So I guess you could look at that in the same vein as you look at the rings on a tree. There are these patterns that happen and then they repeat. So what I found then was that this memory, this footprint actually exists and affects things all along the timeline from when it happened to the following year, the next year, years after that, decades after that. Now, there is some level of falling off in terms of its effectiveness as time goes on, but it's remarkably resilient over that long period of time. So basically, this is what it comes down to. No act in humankind or in nature happens without some sort of consequence to things that are going to follow it or to other people. I mean, this is actually a tenet of chaos theory, and that in these dynamic systems like markets or nature, the outcome of any process that is happening today is very sensitive to its starting point. Now, this goes back to that famous cliche that the flap of a butterfly wing can cause a tornado in Oklahoma, right? I mean, this sort of series of events that could influence different things. Let's get back to volume profile. I found there are features in the profile that tend to have made an indelible mark on the current market. And those features are pretty easy to identify. Now, of course, you listening to this podcast, if you're just listening to the audio version, it's kind of hard for you to maybe see this, but let's assume that you're looking at the video. I'm going to also be showing this on YouTube, so they'll see the video portion of this. But so the profile that I use is with TradingView. I find TradingView is probably the best way to look at this. I put my profile on the right-hand side, and it shows me the visible range of everything that's in my window. And so what I choose to do is to show as much information as I can in the window, because what I want to do is I want to find out what's happening or how the past may be affecting today, how that memory of past events, past market fluctuations, past consolidations and trending, and the laying down of volume in this market structure might affect today. And so the way you can do that is by showing this visible range with a volume profile. It will show you that accumulated volume, where it is and where it isn't, and it will look like these big nodes, like this alien structure almost, spikes that come out and showing you where volume accumulated and where it didn't. Now, these nodes have very steep edges to it, very defined areas where there is an accumulation of volume and very well-defined areas where there isn't. And so what I found was that it wasn't so much the point of control that everybody else is talking about, which is the highest point on one of these nodes. And it certainly wasn't this arbitrary area that they call HVNs and LVNs, which is nothing more than an arbitrary measurement of the amount of volume contained within a particular area, which never really made any sense to me. But it is the actual structure of that profile, the leading edges of those nodes, as well as the lowest points in the LVNs, or what I call the volume wells, or the lack of nodes, that really have impact, because those are the things that, from a market point of view, they're like the edges of the footprint, if you want to look at it that way, that actually create the outline of the footprint. That's the memory. When we have memories, we may not see all the little details. We see the sort of outline of everything, and then we use our brains to fill in those details. But we see the basic shape of things. It's the same thing. Here you see the outline based on these nodes and those leading edges where they fall off at their greatest point. I draw lines there all the way up to wherever they exist to the present day. And I do the same thing on the LVNs, or the volume wells, those areas that have the least amount of volume. There must be a reason why the markets decided to just skip over those areas. So to me, those are important too. So I draw lines there as well. Now, the areas where there are nodes, they tend to provide a level of gravitas. Those are areas where the market has found value. And so price has a tendency, once it's entered a node, and even a past node, to remain there and move in and out of it and find resistance if it tries to move to the top of the node, and support if it tries to move to the bottom of the node. Now, once it breaks through the node, that's a different story. You can look at nodes then like high liquidity versus low liquidity. And we know that when things are in a lower liquidity environment, price tends to move much quicker. And so that's exactly what happens. And that correlates very nicely with the idea that prices tend to either consolidate or they trend. Consolidate being inside of a node, and trending being outside of a node or in a volume well. Now, those low points that are in the volume well also seem to have some real significance on the way price would move through that volume well. So liquidity is more than just lack of volume. There is still some level of substance there, but you can think of those as eddy currents. They're chaotic, but they also seem to have form in small little areas that is constantly undulating and changing. You have these levels that provide some level of inflection as price is moving through. I like to think of them as gateways where price will either come to that level, that lowest level, and get rejected because of some little eddy, or it'll just let it go through to the next one or all the way to the next value node. I've described the behavior of what all this looks like. What we're actually seeing now is something that, well, is it actually there, right? These lines that I drew aren't from any present day action because the action hasn't happened yet. These are from things that happened days, months, or even years ago. Yet price is meeting up with these lines and acting like they are actual physical entities that they must encounter and overcome. How is that possible? Unless there is some level of memory, and there are institutions and big money and other people that have embedded this kind of memory in everything that they do. And so they have orders there that are acting upon those areas. They don't know why, but they like those levels. They don't like those levels. So some people might say, well, are those levels associated with round numbers? Like in the S&P, you have every hundreds, 4,400, 4,300, 4,000, 3,900, 30. Is it associated with that? But it's not. It really isn't. These levels are relatively arbitrary, but they're there and they're consolidated and they're real and you can see them. So that's the whole point here. So not only can we see this market structure, which in fact, that's exactly what it is. We're sort of mapping out the market structure in much the same way that maybe a map maker maps out the various levels and heights of mountainous structures and other things. And we're doing that same exact thing on a price chart. And from there, we're able to relatively, with great confidence, tell where there's going to be support, resistance, and then also how price is likely to behave as it encounters these different elements. So there you go. There's how you can use volume profile and the long-term memory of the market to set up your trades, model your trades based on this memory, this market memory for real-time profits. Hope you enjoyed this episode and join me every Monday morning online, live on YouTube, where I'll show you how I recreate that volume structure of the S&P market. All right, well, I hope you enjoyed that explanation. I think I've shown that there is definitely a long-term memory in the markets. It is there, it's real, and we can use it to understand where the market finds value, where it doesn't find value, or where it's likely to find value or not find value, what the actual structure, the underlying structure is, and we can use that to develop our models of our trades and actually find places where we can literally make money from this invisible, well, not so invisible, market memory. Peace to you all. Take care.